The transition to a climate neutral economy. You are the rapporteur for EU Commission and UNEP-FI, it stands for Finance Initiative, and Energy Efficiency Financial Institution Groups since 2013. And for 5 years, you were the G20's EFTG technical lead. EFTG stands for Energy Efficiency Investment Toolkit. You are the co-chair of Breakthrough Energy European Climate Innovation Hub, and also founder, advisor to the Climate Bond Initiative, advisor to the Climate Lab, advisor to Bremer Energy Ventures, and you were on the steering committee of EY. So it was the former Ernst & Young and Capgemini Invent's work on green recovery. In the year 2000, you became a social entrepreneur, founding 3 high-impact NGOs, Charity Digital, New Philanthropy Capital, and Catalyst Climate Change Trust. You will talk about financing deep renovation with the EU renovation loan. And Peter, please take over.
Thanks, Bruno. Thank you so much for that introduction. And thank you so much again to École de Ponts for inviting me to give a speech. Where I did the same conference last year, had some extremely active engagement with your alumni and your students. And I really appreciate this opportunity to share with you some of the more advanced and sort of actual thinking that's going on regarding climate finance and regarding the financing of the net zero carbon neutral strategy of Europe, particularly as you've identified in the most important area of buildings. So this slide, which just here highlights some of the organizations with whom I've worked. So I've been working for around 20 years in climate finance, and I've done that for both governments and businesses. And I think that one of the reasons why I continue to develop new financial instruments is because I think it's only having a foot in both stools, so understanding how policy is made and understanding the limits and the possibilities of public finance, as well as the limits and the possibilities of private finance, allows you to see how to proceed. And that's exactly what I hope to do today. I shall speak probably for half an hour to set the scene and to provide you some materials. Before you ask, the presentation which I have shared already with colleagues at École de Ponts will be available. So I'm very happy for people to, so those of you taking notes will be happy to know that the presentation will be circulated to you. And today's talk is really divided into 3 main areas that you can see here. So I want to give you the background as to why buildings are important in the European context. I want to describe what is the EU renovation loan. And then I want to describe what, outside of having a financial instrument, is also necessary for our buildings aspirations to be met. So as many of you know, the energy performance of buildings is particularly important to decarbonization, because not only do buildings have a very long useful life, and many of them have been around for, in some cases, hundreds of years, they also use about 40% of Europe's energy. Most of the heat that is used in buildings in Europe comes from burning fossil fuel. And of course, nothing technically prevents these buildings to be made more efficient or built more efficiently. In total, there are 131 million buildings in Europe. And of those buildings, 9% have some renovation each year. Of course, that's a very big figure. Some renovation in the widest sense could mean anything from just painting the walls to replacing a window. But it gives you a sense of how active people are in buildings. 1% of buildings have a renovation which impacts energy performance. That could be, again, as simple as changing the windows and having a better U value, or changing the boiler and having a more efficient boiler. And just 0.2% of buildings optimize for energy efficiency. So that means doing a renovation where the building shell is and the building's current performance is optimized, could be a cost optimal basis, so considering the economic returns on the different measures. It could be an optimization based on the technically highest performance that the building can reach. But it's obviously a very, very small proportion of the renovations that go on. Now, aside from the physical performance related state of European buildings, it's also important for us to understand how buildings are owned and financed in Europe. And I usually step back to do this part of the presentation, because it's surprising how little of this distributional sort of ownership map many people understand. So 70%, 7 out of 10 Europeans live in a home that they own. So that changes dramatically between member states. So rental can be as high as 50% in some member states and can be as low as 10% in other member states. The total value of residential buildings in Europe is approximately 17 trillion euros, the whole sum of the value of all of those buildings. The total outstanding balance of residential mortgages, which is the standard way to borrow to finance buildings that you own, is up to 7 trillion euros. So when you subtract 7 trillion of debt from 17 trillion of value, you are left with 10 trillion of home equity. So that's the amount of value which is in excess of the amount of borrowing that is available to the 70% of Europeans who live in a home they own. Those of you who may be thinking, I wonder how many of the European residential buildings are owned by the governments? The answer is around 8%. So that's 21 million homes. And just to complete sort of our little quick assessment, 15% of European households, there are 220 million households in Europe, 15% of them own a second home. So those clearly are ones that have sufficient capital to be able to own two properties. And again, another figure to sort of benchmark against all of this, because if you've been reading the media, you may have read about how increasingly international funds are buying residential real estate blocks and developing them in different countries. The total amount of institutional, so that's institutional investors who own real estate, the majority of which is commercial real estate, totals 3 trillion euros. So it's not true to say that that institutional investors or financially based returns style investing is responsible for a big proportion of residential building ownership in Europe. So having understood that, what my team and I did is we looked at the 100 million residential buildings to see which ones would be the ones that would most benefit or could most easily be included and renovated in the EU renovation wave, which you may recall has a target to, by 2030, have renovated 35 million buildings. So of the 100 million, the majority are still standing in 2050. 70 million are owned. That's the 70%. So 70 million buildings are owned by the people that live in them. And of those 70 million, 50 million are primary homes. So that's taking away the secondary homes or any of the buildings which are not permanently used as a place of residence. So we got to 50 million. So there's a 50 million primary homes that are owned by the people that live in them and that have by the mathematics, headroom, so some amount of home equity that can be borrowed against. So that's the target group that we think are appropriate to try and incentivize to renovate. So the next question we looked at was, what are current consumer attitudes to renovation and the funding of renovation? So the International Union of Property Owners did a survey that revealed certain key attitudes towards renovation. So this and classic survey questions talk to why do people not renovate if they want to, or who wants to renovate? So 44% of people just are not doing any form of renovations because they simply don't think they need it. Fine. However, 44% of property owners are not renovating because they want to, but they don't have the funds to renovate. So I would argue that's quite a strong pent-up demand for renovation. And below 10% saw lack of information or lack of qualified services as a significant barrier to renovation. So again, this survey talks to the difference between lack of funding as a reason to not proceed versus lack of information or lack of qualified workmanship. Again, pointing to the fact that lack of funding appears to be 4 times as prevalent as a reason for not renovating than lack of skills and workforce. So then we did a quick analysis looking at what we call value for money. So one of the things that I feel very strongly about is government policy should not be forcing people to do renovations if the renovations aren't going to make financial good sense. And the good news is that in our modeling so we looked at different European regions. So the 4 bars on this chart show the southern European region, the west, so the west and northwest, obviously requiring more heating costs. So obviously the cooler the country, the more heating costs are required. That's why the bars are taller. Southeast, a lower bar, northeast and central. And so obviously this is the y-axis on this chart is this is both costs and savings. So this is a chart that looks at the euros per meter squared of costs of renovation versus the present value of the energy savings added to a 5% green premium. So just to be clear, the yellow bars are the present value of energy savings that can be attributed to a deep renovation in the different regions based on secondary research that we have referenced in our report. A 5% green premium based on the median value of the property in those areas. So, and then set against that in blue, the dark blue is the cost of a median renovation in euros per meter squared, and the light blue, the total cost of a deep renovation. So where the bar is taller than the blue background, that means that economically the renovations are working in those geographies. And in most cases, using a discount rate of 3%, and assuming that a deep renovation cuts bills in half, and assuming the green premium is a conservative 5%, meaning when you've invested in the property, the value goes up by 5%, which is backed off by work that has been produced by the JRC that shows the range, and the EFIG group that shows the range could be up to 8%, and not including any CO2 benefits, so not including any white certificates or any form of repayment as a result of the CO2 reductions inherent in reducing energy use. It shows that broadly speaking, at 3%, the economics of deep renovation makes sense. Now, when you change the discount rate to 15%, and we did this as an illustration exercise to show how important the cost of funds is to the value perception of a deep renovation. What you see is that the yellow bars have all gone down in size. And that's because if you do a deep renovation that saves future energy costs across multiple years, particularly deep renovations that require many years to pay back, the higher the discount rate, the lower the present value, which makes the economics just look worse. And there's a whole science of behavioral economics that talk about what types of discount rates regular consumers use to look at bargains and purchases they make in daily life. What the chart shows is that if your discount rate is 15% or your cost of funds is at a high rate, then it's very hard to make the economics of deep renovation work in all the European areas. So with that, as a base analysis, so in summary, the need to identify 50 million homeowners living in their homes as a primary residence with sufficient home equity to borrow against, the recognition that borrowing costs must be very low in order to make deep renovations work for all concerned, we thought, okay, let's look and see if those types of financial instruments are widely available. And if they're not, what financial instrument would really address this problem? So my team and I wrote a report, which we will send the link to, which this presentation is based upon, describing the EU renovation loan. So we describe the EU renovation loan as an EU-backed, privately contracted, collateralized loan that provides all homeowners fair and equal access to long-term financing for the deep renovation of their home. The funding is provided on a zero coupon basis with repayment of the principal and accrued interest at EU borrowing costs upon the earlier of transfer, sale, or its 30-year maturity. So I know that's a mouthful, but what I'm going to do now is go into each one of those design concepts of the EU renovation loan to tell you what it is and why it's important. So as I've said before, there are some design features that clearly are important. First of all, the EU renovation loan needs to unlock home equity. So it's a collateralized loan. It's borrowed against the value of the property. And it can be repaid by homeowners through the monetization of energy savings and value uplift. Clearly, loans that qualify for EU renovation loans need to be aligned with the EU taxonomy and specifically the significant contribution criterion for climate mitigation for renovation. And we designed a zero coupon structure. So a zero coupon structure is just simply one where instead of paying monthly or annual interest payments on the loan and or any repayments, the full payment of interest and the full repayment of capital is done at the end. So that the end would be defined as when you sell the property, and therefore all the debt against the property needs to be paid back. When you transfer the property, so that just means in the case of passing it as an inheritance through a will, or after a 30-year time period has elapsed. The borrowing amount of the EU renovation loan needs to be capped at the home value, so you can't borrow more than the property's worth. It needs to be collateralized by a home, but the collateralization can be done as a second lien to the mortgage. So if you have an existing mortgage, you don't have to touch it or change it. You just you provide essentially your property's value provides the second lien or the second guarantee that's junior to the existing mortgage. Why? Because we don't want distributing banks being concerned that this impacts the seniority of their existing structures. There would be an EU guarantee made available to the originator to cover any potential future collateral insufficiency. The interest rate would be struck at the 30-year borrowing cost of the EU because of that guarantee. So in other words, because the EU's backing this instrument, then the interest charges will be the same as the EU because the credit risk is being absorbed by the EU. And there would be a central bank liquidity facility, which would both meet the ECB's interest to green its own balance sheet and provide liquidity to originators. So really sort of looking at those components, perhaps in more detail, we think that given the enormous amount of money that's needed to deliver the 35 million deep renovations, which I'd mentioned is included in the EU renovation wave, we think that only an instrument that can be massively replicated across all of the mortgage originators and retail banking organizations in Europe, made available on an equal footing to any homeowner, is the only an instrument of those characteristics will be able to deal with the sheer size of needing to deliver 3.5 million renovations a year. We think that it meets quite neatly, or this instrument deals quite neatly with two specific consumer perspectives that currently we believe are underserved by financial instruments with respect to renovations. The first group, a very significant group, would be elderly owners who are on pensions that may or may not be keeping pace with inflation currently. So so what's interesting is, in a number of surveys that I have read, a lot of home ownership is clearly concentrated among older people, and older people are more likely to have bought properties a long time ago that have benefited from asset inflation, and therefore who have a lot of home equity, i.e. capacity to borrow against those properties. Furthermore, they are going to be more likely to be negatively impacted by cold snaps and by weather difficulties of an inefficient property. They're more likely to be energy vulnerable, and they are more likely to benefit from a zero coupon structure, one where they can take the energy savings to cash, meaning they can see the benefit of the cutting of their energy bills immediately, and then pay the rolling interest costs at the end when the property is sold. This also has the benefit of enabling elderly owners to stay for longer in their homes. So there is another social trend, which is that people wish to age in their homes and they need accessibility upgrades. Those accessibility upgrades can be combined with an energy saving safeguard upgrade, and therefore deliver both longevity and reduced bills in their homes. So that would be one group. And of course, this group cannot access typically mortgages being the most efficient form of financing for buildings. But as an older person, you may not qualify for a mortgage. And so therefore, the EU renovation loan's existence would provide a new and very attractive means for them to access capital to renovate. And the second target audience would be young couples with existing high debt. So this is young couples with no savings who are unable to borrow any further against the headroom that they have in their property, but want to do a renovation to reduce their energy costs. And so those two, and they can't get a mortgage because they've reached the loan to value cap on the mortgages, so they can't extend their mortgages. So those are two communities currently we see being underserved, and for whom we think the EU renovation loan has a particular attraction. If I keep going, there are some peculiar mathematical features which relate to a zero coupon instrument, which I think need to be recognized. So in my opinion, EU renovation loan zero coupon structures only work when interest rates are low, relatively speaking. Why do I say that? Because when you don't pay the interest and you let it roll up and have to repay the capital at the end, the higher the interest rate, the faster the the compounding effect is, which means, as this chart on the right-hand side of the screen illustrates, if you borrow 20,000, so you're a flat owner in a regional French town, you need 20,000 to do a deep renovation that saves half your energy bills. If you need to repay in 30 years at an interest rate of 1%, then you need to repay 28,500. If it's 2%, it's just over, it's 34,000 if memory serves. If it's 3%, it's close to 50,000. If it's 4%, borrowing the same amount, the 20,000, you're repaying nearly 70,000. And if it's 5%, you're repaying nearly 90,000. The optics of a 5% accrual are fairly poor. So if you're told that you're borrowing 20,000 and you have to repay 90,000 in 30 years' time, even though the expectation is that your home price would increase by 5%, which is the historical European home price increase per annum since 1839, the optics are still fairly unattractive. This is one of the reasons why we think that the EU renovation loan only works at EU borrowing costs. And of course, we think that to make it a quote unquote good deal, it should certainly be struck at a price that beats inflation. So how does this look from the perspective of governments? Well, we need to find 235 billion euros annually. And at the moment, governments are suffering a fiscal shortage. There are just 25 billion annual attributions from recovery funds to buildings renovation. So that's under 10% of what is needed. And it's clear to me that notwithstanding lots of good programs based on government grants and other forms of subsidy, we're way off, very insufficient quantities compared to the amount that is called for in the current EU climate and energy targets, and indeed in the EU renovation wave. It is my calculation that the EU provision of a guarantee against the non-repayment by borrowers of a zero coupon structure, which is collateralized by a property with a second lien, subject to the terms which I've described, is potentially 100 times more efficient from the government balance sheet allocation perspective than a direct subsidy would be. So that means that you get 100 times more renovation, which is 100 times more jobs and 100 times more saved energy, and so on and so forth, per euro of government balance sheet allocated. The TLTRO, so that's the long-term liquidity facility provided by the ECB, would also is currently being used significantly to provide liquidity for other means. We think that this would be a way of taking that existing instrument and making it work to back renovation specifically. And I think that that would certainly activate a drive, which we have not seen, from retail lenders to offer EU renovation loans, because when originated, not only do they benefit from the guarantee, so therefore they're not going to undergo losses as a result of lending to customers who they might not have chosen to lend to otherwise. Also, they can get a funding spread, so they can place that asset with the central bank in this facility, and they can earn a positive funding spread. So in other words, there's a natural way for originators to ensure that they can fund at the levels to make this type of business attractive to them. This picture shows the kinds of institutional relationships and fund flows that I think would support thousands of branch offerings. So one key detail, which I think comes further in the presentation, is there are around 130,000 retail bank branches in the EU 27. So 130,000 banks in my calculations would have to train and have access to 3 energy efficiency renovation project managers each, who would each of those 3 would have to do 10 renovations a year. for us to have delivered the 3.5 million renovations that are necessary to deliver the EU renovation wave. So I guess the rule of big numbers, the more retail lenders you have offering the product in the more regions, the more product will, the more of the millions are likely to be served. And this structure with the combined power of a guarantee and a liquidity facility being provided to those lenders would make this business attractive to them. So the renovation market is, roughly speaking, let's call it 100 billion to make the numbers easier. Call it 100 billion of size annually. Looking at distribution fees on that, I calculate that potentially the distribution fees to originators could be in the order of magnitude of €1 billion. So again, without wanting to sort of over-egg this, from the perspective of an originator or a lender, this should look like a very attractive low-risk market for them to get into as a way of improving the credit quality of their existing mortgage book. So imagine the situation where you already have exposure to these buildings, you already have a certain set of clients who already owe you money and they're trying to make their mortgage payments, and the interest rate environment, as we know, is going up. If you provide to one of your existing clients an EU renovation loan, and they do a renovation with that money on their property, then immediately they become a better credit for you on your existing mortgage. And I would argue you could green your existing mortgage if you met the taxonomy thresholds for the delivery of the energy savings. Meaning you have an existing relationship, the customer has headroom in their account, you offer them an EU renovation loan, they accept it, they do the renovation activities, they reduce their energy bills by half. That makes them much more likely to be able to pay your interest and capital that you have lent to them under the first mortgage. That greens the first mortgage, therefore allowing you to perform better under your green asset ratio test. Because the EU renovation loan is both guaranteed and a zero coupon instrument, that will be repaid finally at the end of its life or when the property is sold. The renovation loan I've looked at in parallel to and talked to some of the organizations who are currently in the business of offering in France the Eco-PTZ, which is the zero interest. So there's a difference between zero coupon, that's a cash delaying mechanism that accrues to the end, and actually zero interest. So zero interest requires a government subsidy because that's the difference between the current interest rate you would have to charge and the amount that the customer would normally pay. Nevertheless, the Eco-PTZ is designed for a segment of the population who cannot afford interest, and therefore they would be the EURL would sit neatly to deal with a segment who would not have access to the Eco-PTZs because they're too wealthy, but they would also benefit, perhaps the elder people that I've mentioned, from being able to unlock at cost-effective rates the equity they hold in their properties. I've also see that in Germany, this would sit neatly alongside the KfW's existing promotional support strategies for renovation buildings that are very extensively developed in Germany. And of course, it would also sit alongside the Eco Bonus program in Italy. So having said that, and having described to you what the renovation loan, the EU renovation loan looks like, what else apart from a good design financial instrument would be necessary? So there are three directives which guide the framework in the framework in which energy efficiency, buildings, renovation, and mortgages are controlled. That's the Energy Efficiency Directive, the Energy Performance in Buildings Directive, and the Mortgage Credit Directive. All of those are providing a level of pressure to ensure that both energy performance certificates are improved, that certification schemes for renovation contractors are upgraded, and that there's sufficient high quality training programs in place. And I perhaps should have, the slide is a little old, perhaps I should have included the net zero investment academies that have just been announced in the context of the Net Zero Industry Act. And I think there's definite focus on needing to ensure that the skills are available in Europe to deliver the needed renovations. I calculated, based on a very simple approach, modeling from the German government's network. The German's energy agency, Dana, has a network of 13,000 government-accredited energy experts that work and co-sign loans offered through retail banks by the state banks KfW. And here, these independent renovation advisors are involved with those customers preparing technical projects, arranging the financing, and are required to co-sign the loans. So I used that as a way of figuring out how many renovation project managers would we need to deliver the renovation wave. I think the number is 350,000 across Europe. And based on the simple mathematics I was describing earlier, if we use the 138,000 bank branches, all offering EU renovation loans, then each would have to be in touch with 3 local agents doing 10 projects a year in order to cover the whole of Europe's renovation needs. So this I can do relatively quickly. So where currently does the EU renovation loan actually appear in the legislative texts? Well, on the 9th of February, the ITRE Committee of European Parliament adopted their amended version of the Energy Performance of Buildings Directive, where in paragraph 46A, you can see that they call for the Union to develop a special renovation instrument called the EU Renovation Loan that should be established to provide homeowners with access to Union long-term borrowing costs for deep renovation, something which I think would be just great. I think last time I spoke to you as an audience, I described something called mortgage portfolio standards. That's also included in all 3 texts of the Energy Performance of Buildings Directive. So meaning the Commission's text, the Council's text, and the European Parliament's position. I think that's important to note because I believe that the 2 instruments, so a mortgage portfolio standard that forces lenders to look through their books to identify the low-hanging fruit, so which of their customers have the worst performing buildings that you've lent against and that need to be upgraded to avoid being caught in minimum energy performance standards. So together, the EU renovation loan and the mortgage portfolio standard sum up to facilitate the minimum energy performance standard. And this is something which I think is the perfect setup in order to ensure that all buildings owners are not caught by minimum standards, but they are facilitated by those incentivized to help them renovate and by the kind of funding which is appropriate to that. These are photographs of the chairman of the ITRE committee voting in Parliament. Member of European Parliament Maria Spiraki also highlighted the need for an EU renovation loan when she spoke. And this is a photograph of her speaking in front of the Commissioner on the 13th of March. On the 14th of March, the EU Parliament approved their version of the Energy Performance of Buildings Directive, which had included within it the definition of mortgage portfolio standards, which is here, and the utilization of it, and had that reference which I described to you earlier from the ITRE's opinion was carried forward, paragraph 46A, into the agreed text by the plenary of Parliament. I'll also note that that agreed text also references the need for the EIB to think about helping develop an EU renovation loan. What's interesting, and for those of you really interested in the details, I think that InvestEU, which is a facility which provides a guarantee for specific activities covered by the InvestEU program, has an example term sheet. So that's managed by the EIB, and that has an example term sheet, which I think would fit perfectly for the provision of an EU renovation loan guarantee. So again, the reason I give you that detailed example is because the building components of this are already, I think, developed. And then finally, these are my last 2 slides. There are 6 takeaway conclusions I'd like you to remember. The first is that we must be doing things at the million scale. So we have 3.5 million deep renovations to do annually, and we're falling far short of that. The money is locked in our buildings. So our buildings are valuable, and that money, the 10 trillion euros, some of it is going to be needed to be borrowed against in order to provide the renovation work, the fund for the renovation work. There are standards. There are, when we design a standardized instrument like an EU renovation loan, it can be immediately offered by thousands of approved lenders across all of Europe, so it can really deal with the scale of the challenge. Existing components can be utilized. So the things I've described today are not new inventions. They are just using components of the market systems to deliver specific impact in renovation. So zero coupon securities are commonplace. Guarantees clearly commonplace, and TLTRO facilities at the ECB very well used. I believe this aligns the interests of lenders with the EU institutions and customers, terribly important. And I think that would also provide the confidence that's needed for member states to really engage in the training and the rationalization and the upgrading of the supply chain to renovation. Therefore, what actions are my team and I calling for now? So I think we need a technical task force to be launched that would have senior members of relevant EU institutions to deliver a blueprint for the EU renovation loan. So, of course, I'm talking about things that are not yet legislated for, but in the coming future, I would expect to see something like that in order for this to happen, because there's obviously a lot of technical detail behind what I've described. The Fit for 55 package and the EPBD, of course, must have this, must create the components to drive the renovation and the framework that's necessary to deliver not just the financing. Retail lenders, I think, must urgently address mortgage portfolio climate risks. So in other words, with the deployment of minimum energy performance standards, clearly there's a risk newly of stranded assets within mortgage portfolios, and banks and lenders just need to know where they are. So they must start to engage properly with their mortgage portfolios and an analysis there. And finally, and we always say this, financial and prudential frameworks must be reviewed to ensure that they're not inadvertently preventing the EU renovation loan from working. I don't think they are, but it's just a sort of safeguard. So the rest of this presentation talks to the press. There's been a lot of articles written about the elements that I've described in this presentation, and they're here for your reference. And if those of you who are watching this online, if you pick up your phone and you point it at that QR code in the very middle of this last slide, it'll take you straight to the report, which is over 100 pages on the subject, which you can download. And if all else fails and you need to reach us, our contact details are to the right. And I would now be very happy indeed to take any questions that you may have. Thank you.
This very detailed presentation dealing with, of course, very important topic, which is the financing of renovation.